Okay, good evening, guys. Before we start, as always, let's do a customary instant poll. Check everyone can hear the volume correctly. I'm going to put that on your screens now. Just let me know if you can hear the volume perfectly, too loud or too low. Just indicate by pressing 1, 2, or 3 on your on your keyboards. Okay, the majority of people are saying perfect. Anybody else? Okay, guys, that's absolutely perfect. Thank you for that. Okay, what we're going to talk about tonight is trading and probabilities. So it's really all about giving ourselves the edge. So trying to find out what the market sentiment is, what the market's thinking, and making sure we're positioned in a sensible way in order to maximize what's happening. Market's a little bit interesting at the minute, a lot of conflicting views, a lot of conflicting directions within the markets. But as long as we understand how we're going to trade, how we're going to approach the markets, we're going to give ourselves the edge and be able to hopefully make some money. Right, guys, before I start, as always, I need to read a risk warning. Spread betting and CFD trading both carry a high level of risk to your capital, with the possibility of losing more than your initial investment. These products might be suitable for all investors and are only intended for people over the age of 18. Please ensure you're fully aware of the risks involved and, if necessary, seek independent financial advice. Again, this is education only. The content of the webinar is the personal opinion of the moderator, not intertrade.com. The content does not constitute financial, investment, or tax advice. You're advised to discuss your specific requirements with an independent financial advisor prior to entering any bet. Intertrade.com is not responsible and disclaims all and any liability for the content or comment during this session. So again, what we're going to talk about tonight is trading in probabilities. When we talk about trading, it's very important, even when we use the term spread betting, that we're not gambling. Okay? Them very words, spread betting, imply that we could be gambling, having a bit of a punt. We've got a vague idea what might be happening, where the markets could go. You know, for me as a trader, I've done this for years and years. It couldn't be far enough away from the truth to even merit or be worthy of talking about. So when we talk about our trading session, our trading day, our trading career, these are all the positive words, all the positive things we need to be saying. We're not just turning on our spread betting platform, loading up InterTrader and going, okay, well the market's clearly overbought today, so we're going to sell it. That's not really what we're all about. Again, if you've attended the Building Blocks of Trading course, where we go through why we should have a trading plan, why we should have rules in place, it's all very easy. And I can use a perfect example. Now, I took a short position and have been doing on the S&P over the last few weeks. And I let my position, because I've done it for so long, and because I almost write and make the rules, them lines always get blurred. So I let my position go against me. And because I knew where the market could go to, and I knew what the overall market sentiment was, I started to average in and hold a position just because I could, not because I wanted to. Okay, so all my rules were telling me, screaming to me, get out, cut your position. So luckily, I did. So what I could then do is let the market push itself higher. Again, when we see all the news coming into the markets, like the UK slipping back into recession, we know that the world's not fixed itself overnight. We know there's still problems in Europe. We know that the deficits and the GDPs are being squeezed. So the overall sentiment of the world, the global economy, isn't getting any better. So instead of holding on to a position and just negatively averaging, hoping the market will come back, we accept and take a loss, wait for the market to overextend, go even higher as we know it can be pushed. And then we take a new view, a clear view with no money actually, invested in the markets, and then almost kind of reevaluate. Okay, so when you know you're wrong and you've taken out a loss, and nobody likes doing this, and it's never going to get easier. But if you can accept that you're wrong at that time, you averaged in, probably put a little bit too much size on a position that you knew wasn't right for the market conditions, but you accept that loss, you let the market go up, and instead of just getting involved just because you think that's the top of the market, you actually tie in your technicals, you tie in your fundamental views, and you look for the market's telling you that that's enough, that we've gone high enough for now, it's time to take some profit, or it's time to turn, it's time to let people put in their new opinions and let that become the market sentiment. So again, all the things I teach and all the things about trading probabilities, trading with your rules, I do it all from personal experience, okay? Years and years in the markets, years of teaching people to trade. You'd think there'd be some guaranteed formula, some guaranteed way of consistently being successful. The only thing I've ever really realized is that the only thing you can consistently do is get out when you're wrong. Okay, it's easy or fairly easy to get out of a trade when you're right. Yeah, everyone likes to take out a winning trade. And even I've seen some comments already that if you take 10, 15, 20 ticks out of the market, you're still a winner. Nobody likes taking a loser out. Doesn't matter if it's a scratch, a small loss, or a big loss. Nobody likes it. But the quicker that we can accept this as a part of trading and an absolute cast iron inevitability, the better we're going to be as traders and the more successful we're going to be in the long run. Yeah. Because if I'd held on to my trade, then I probably would have averaged in all the way up. I could have easily, lost a sizable amount of money. But again, even sticking to your risk reward, sticking to your basic rules and saying, okay, well, if the market goes against me this much, then for this period of time, I have to be wrong. Doesn't mean I'm wrong overall. It doesn't mean that it was the wrong trade for my opinion. It just means that that period in time, that particular trading session, that I was not right. The market was going up and it wasn't going to sell off. Okay, so then we have to get out the position, accept we've taken a loss. We know we have enough capital to cover this and carry on trading. Then we trade accordingly. So these are the things when I talk about trading is not gambling, and trading in probabilities is a real strength, something we need to hold on to. It can't be more important. So again, just because you can put more into a seemingly good trade at the time, but if it's going against you and the markets are pushing in a way that you A, don't understand, or B, don't feel comfortable with, the best advice, the only advice I can give you is to get out and to reassess. There's absolutely no point in trading when the markets, when you're not feeling them and they're going against your gut and your core feeling. Yeah. So when you're trading with probabilities, it always has to feel right. It has to tie in with your indicators. So again, be this fundamental or technical, and it has to tie in with your opinion. It has to give you the confidence. If it's not giving you the confidence, you're feeling apprehensive. You know this by you'll be checking your charts every 15 minutes instead of every hour. You'll be looking on Bloomberg for some news, something to gauge why the market's not going in the right sentiment that you've got. Okay, so when we're talking about trading, there's obvious elements of risk. So it's how we manage this is how we become good and successful traders. Okay, the only way gamblers manage risk is by how much physical money they've got. If we start doing that as a trader, it's a very dangerous game. So again, all the things I teach in the Building Blocks of Trading course and all the things that I talk about in every seminar is all back to the basics, what I was taught, what was drilled into me as a very young trader. Have a plan, okay? Stick to a formula and learn from your mistakes. Repetition is fundamental in trading, okay? If you keep doing things that are right, you're going to get the confidence from it. If you keep doing things that are wrong, you're going to lose your capital and you're out of the game. So these are the things you really need to hold on to. It's not to say that you need a rigid plan that you can't ever change, okay? Again, all the things I teach is all about having a plan and a framework and working around that. Then you have to apply this framework to the market conditions, okay? If the markets are breaking out, then you can't be trading off levels. You can't be looking for bounces. You need to go with the volume, go with the momentum. So again, it's all about being adaptive and making sure you stick to your core rules, which is I can't lose X amount of pips or X amount of money, in a day, because that will affect my trading capital or my ability to trade. But then also having the flexibility to understand when you're trading badly and cut down your size, or when you're trading well and you're going with the market sentiment and upping your size. Yeah, these are the things, the two real core things that will take you from being a good, average, steady trader to being someone that could really make good money at the markets. And again, the markets are moving a lot in the current economic climate. So the more it moves, the more opportunities we have, the more opportunities there are to make money. So volatility as a trader, especially a day trader, is good, but only if you control and on the right side of the move. So there's really 3 steps that I always say that you can make trading work for you, okay? Trading, there's always a lot of things going on simultaneously. A lot of fundamental things, a lot of different markets moving, a lot of people that trade the markets, changing the sentiment. All you can control is what you do and how you prepare, okay? So point 1, preparation. What are you going to do? What are you going to trade? What are your levels? What's your bias? All these things, again, are in a trading plan. You can make again, them as rigid or as flexible as you want. But you have to know. You have to know what you're doing today. What's your aim? Yeah. Again, you won't start a business and have no business plan. You won't start a flower shop, for instance, without knowing where to get flowers from or how much flowers cost. You have to put it and break it down into these things. If you attack the markets and just trade because the markets are moving, then you're against other people that have done preparation, have plans in place, have contingencies. You're always going to be in the back foot. So the more prepared you are, yeah, the more confidence you're going to have, and the better position you're going to be to interact with the market. And that might be not interacting with the market when you're not understanding it, and going in hard when you do see good signals and you've got the confidence to trade in the way you want to. Okay, so point two, what are your expectations? Okay, where's your out? Where do you know you're wrong? Yeah, where were you positioned that you know the market is going too far against you in order to have a sustainable position? Yeah, where do you think the markets are going to go? What was yesterday's daily range? What are the pivot points? Yeah, what are the analysts saying? Yeah, what are the key technical levels? What are the previous highs and lows? You know, where could the market realistically trade from and to? So point three, how are you feeling? Are you ready to trade and win? Or are you just hoping? Yeah, this is the psychological side. Yeah, we all are allowed our bad days. We all have stresses and strains in our lives. If this isn't our full-time job and we're just, turning on because we've heard some fundamental news or we know we're coming close to a technical level, is this really where we want to be traded? Are we ready? And these are all the things that will give you that little tiny edge. And trust me, they all build up. They all seem like very small things, but used together in the right way, yeah, they're going to give you much, much more confidence than you'll ever know. And again, it gives you something to fall back on when times aren't good. And you say to yourself, okay, well, I'm identifying that this isn't working, this style of trading isn't working. So instead of trying to fight the markets and say the questions or say things like in the self-talk that I don't understand what's going on, the market shouldn't be doing this, why is this happening? That we have the confidence and the strength as a trader to sit out and go, okay, well, until I do understand it, I'm going to stay out and just watch it. Yeah, and I'll protect my capital. I'll protect my core. It's preparation. Very, very important that we have some sort of basic plan. Again, it doesn't have to be, a half an hour, long drawn out business plan. Again, it all depends on what style of trade you are and how much you want to invest. But preparation is very important. I mean, please, you're the trader. I can't tell you what to do, but don't just log on and trade. Don't just turn on and see a level without looking at charts or reading, the wires and just put a trade on. But where's the confidence come from? So you have to look at things like what have the currency pairs done overnight? If you're trading the US markets, what's happening in Asia? All these little things, very easy to find out. All this information is very, very accessible. As with overnight news, what happened in the markets that were trading when the markets we want to trade were closed. Okay, did the markets move as you expected? What's the overall sentiment? Very, very important that we check our economic calendar. So what's coming out? Again, I do 2 live trading sessions a month, so you can watch me. We traded Philly Fed, off a very small stake. We made £550. So again, another successful trade. But again, we're prepared for it. We knew what the figure could be. We knew what the market was expecting, yeah, and we traded accordingly. So these are the things. These can be your money days. Yeah, maybe there's only 1 or 2 figures a month you want to trade. But if you can make good money, you can double or treble what you expect to make from normal trading just by having these one good trades. So again, if you're trading technically, what are your levels? What are your targets? What's the rest of the market looking for? Remember, you're trading the sentiment. You're trading with other traders. What are they expecting to happen? Yeah, if you're inside of what the analysts, what the other traders are doing, then you can position yourself in the right way. So the market gets squeezed or pushed out of line. You know where the thresholds are, where the stops are. Okay, and then weekend analysis. Very, very important. So weekend analysis, again, is much more important than people probably give credit for, because hopefully you won't be holding positions over the weekend and then the markets are closed. So this really gives you 2 days to look over what you've done as a trader. So hopefully we all keep some sort of log or some sort of justification to why we put that trade on, to what we did. Yeah, and then we can review that. Were we right? Were we selling the market when the markets were pushing up and losing money? Or were we buying when the market was pushing down? What we were looking at? What was our technical indicators saying? Yeah. What were the oscillators saying? What were the market analysts saying? What was our justification for doing these trades? And overall, did we make or lose money? So again, like I said, if you're not running overnight positions, it gives you a good opportunity to have 2 days when all the markets are closed and build, your outlook for the next week based on history, based on what you've done. You're going to do more of the same, if you've been right, or you're going to change your slant, change, what you think in the market's going to do. Then again, like I said, the economic calendar, we can plan around data releases, plan about central bank speeches, all the speakers we should be aware of, like Draghi, Bernanke, all these people that are moving the markets. Yeah, these are all readily available on InterTrader's economic calendar. So we should all make a note of it. We should know the big speakers, what they could do to the markets, and then trade around it. Again, non-farm payrolls, first Friday of every month. There's absolutely no point trading the morning of non-farm payrolls. Yeah, people are building up opinions, people could be swaying the market, so we wait for the figure. Yeah, and generally, if you watch the live sessions, we generally make money. So again, we wait for that figure and we don't put ourselves or risk any of our capital before this big figure comes out and the market makes its opinions. So think to yourself, are you going to plan a bullish or bearish stance, or are you market neutral? Okay, there's nothing wrong with not having an opinion. You just go off the market flow and what the market's doing. But if you do have an opinion, what's it backed up by? Yeah, what are you looking at to give you that bias? Then again, we can put a sliding scale of importance on figures. We don't have to trade every figure that comes out. Again, if we trade in the European markets, we trade some European figures and the majority of the US figures. Again, if we trade in the US markets, then we don't look at European figures. They're not as important. So again, we need to know what's coming out and what we can potentially use to our advantage and make money. So point one overview. If you can say you've done 80% of the points, then I'd say you're prepared. Remember, we're not gambling. This is trading. So if you've done your preparation, in my eyes, even if you've done 5 or 10 minutes, you've earned the right to trade. It's not as simple as just because it's your money, you can do what you want. That's a bad attitude to have, okay? It's your money, you need to protect it, and everybody else in the market wants it. So if you're prepared and you're confident in what you're doing, you're protecting your money. And all the things I keep saying, like when you do the courses and you listen to these webinars, it's putting a brick wall up in front of your capital. It's protecting you from the markets. And you only go out and get yourself involved in the markets when you're feeling confident, when you're feeling strong, when your indicators are with you, you've got the right kind of feeling, the right kind of confidence. And when you do that, trading generally works out. Yeah, when you're not feeling confident, again, that's more the punting style, that's more the gambling style, and you're going to get caught out. Again, it's just from years and years of being in the market and speaking to literally hundreds of traders, and these are the things I've kind of picked out and designed these webinars all around just to tell you what's happening in the markets every day. So again, very important that we get our confidence from being prepared, having some sort of plan, and having some sort of direction in our trading career, not just pressing the button to buy and sell. So point two, exiting a trade. So putting on the trade can relatively be the easy part. Okay, the exit part is the real art of trading, because again, we have to understand where we've got in, what risk we've taken on, and what we want to get out. What's our reward for taking on that risk? So this is really where the trading in probabilities comes in. So we need to ask ourselves what might seem fairly rudimentary and obvious questions, but what's the market done? Okay, so the market's rallied 100 ticks in the last hour. What's it likely to do? Is it going to rally another 100 ticks, or is it going to retrace some? What's the trend? Are you going with the overall trend, or are you counter trend trading? Again, you can quite easily figure out what's happening by what percentage of markets up or down and just drawing in simple trend lines. So again, are we looking for bounces? Are we looking for breakouts? What style of trading is going to suit where the market is currently at? So have you traded these levels before? What's happened? Again, use the past to predict the future. These levels have held for 5, 6, 7, 8, 9 times. Are they likely to break? Is there enough volume to break through these levels? Or are they going to hold it yet again? So again, if you look at different products, how they're trading, cable at the minute has had, I think it's 9 green updates. In the last 10 years, it's only ever had 10. So how far could the market go up? What's the most likely? What's the most probable outcome? Will we see 15 updates, or will we see at some point a big downward move? Because again, markets will only move up and down, or up for a certain amount of time in one direction. They always have to correct, find some sort of equilibrium. Because again, for every buyer, there will be sellers, and there's different values at different points in the charts. So again, probabilities. We can use a very, very simple chart, yeah, and use a very simple technique as in channel trending that we've covered previously in previous webinars. This is a bullish trend. Yeah, we go from the low side of support here to the high side of resistance up here. Okay, so what do we do? What's the most probable outcome? Well, when the market comes down, people see value, more traders come into the market, push the market higher. So anytime this simple trend channel, we come back into here, we're finding value. So the market goes up, we sell out. Market goes up, we sell out. So there's 1, 2, 3, 4, 5, 6, 7, maybe 8 times that particular trend breaks back into that trend channel. So we don't look to sell at any point. The only time we sell is to exit our trade. So when any time the market is low, comes within our levels of support, yeah, we sell out for profit. That's trading in probabilities. Trade with what the market wants to do, what the market's telling you, and only do it from one direction. Don't try and be greedy. Don't sell into a bullish move. Yeah, if we know that people are buying, then look for the low points, look for value, and go with the market. Go with the sentiment, the volume, yeah, and the direction. Very, very important. And you might not be able to trade as much, but if you can trade and get on side quicker and take more profit, then why get involved in the other side of the market that isn't what the market wants to do? So again, it's very powerful when you identify these things and you start trading and start making money from it. Then again, it again gives you that instilled confidence and you do it more often. So the trend is your friend. Okay, one thing's for certain, be it sideways, bullish or bearish, all markets will trend. So again, it's all about going with the probable outcome. There's no point, yeah, trading a sideways trend market looking for breakouts, yeah, because that's not the probable outcome. Yeah, the market will settle back into equilibrium, into value if it's ranging. So only go for breakout trades on the upside or downside when we've clearly identified that there's the volume and the markets are breaking out. So again, it's all about applying your style, your bias, your thoughts on the market to the right market conditions. Because all the will in the world is that you can't make a market that's going down, yeah, go up. You don't have the size, you don't have the trading equity. Okay, no one really does. Okay, people can manipulate markets for small periods of time. That's the whole point of the markets. Yeah, they're coming together, and that's what makes the markets move. The majority of people trading that way. There's no point trying to fight against it. Yeah, all you'll do is find that you get frustrated, you do bad trades, and you lose money. So again, it's all about going with the trend. When I started as a trader, yeah, in the younger days, I was a counter trend trader. Over the first 2 or 3 months, I made fortunes. But that's because I caught the market at the right time. For the next 2 or 3 months, I got absolutely carted out because the market wasn't doing what I expected, and I just stuck to a rigid plan. And it's not until a very clever and experienced trader kind of sat me down and said, "All right, Steve, it sounds corny. But what you have to look at the markets is that the trend is your friend." And that's, to be honest, the first time that I'd heard that phrase, and he explained it as in the trend is not just a phrase, but it's the sentiment. It's again, if the market's going up, then people are looking for reasons to buy. You're going to get on the right side. You're going to look for the positive information, and the market's going to feed off that and go up. So again, look for the value, look for the opportunities, and trade with what the market's telling you. So again, what we need to do is just adapt our style to what the market's telling us, and then make sure we're involved in the right side of it. So there's no point buying, yeah, towards the top of a range, even if it's a bullish market. Yeah, we want to be looking on the downside. It's almost the opposite. So when the market's going up, all we're doing is looking at low points on the chart that you could go to start buying. There's no point trying to buy on the way up and then not getting, that full momentum. So that's what we need to do. We need to look at the charts and almost re-engineer it and reverse it. So again, drawing trend lines, drawing trend channels, and try and pick the extremities on the opposite side for your entry point, because the opposite lines and your top levels and your bottom levels, the extremes, that's where you want to be getting out. That's where the market could go to. So it's almost like looking at it from the reverse point. So again, remember the probability principles. The trend is your friend. If identified as a bullish trend, look to buy. Yeah, any high point should be your exit. Don't be greedy. Okay, don't try and scalp the market for a few ticks. If you picked somewhere at value, okay, and you're not retracing, you're not closing below the moving average or closing below your entry point, then again, in this perfect example, if you buy anywhere along the bottom line, you want to be exiting at the midpoint or anywhere towards the top line. Yeah, you want to hold it. You know you're right. You know it's a bullish trend, and you know from previous experience that we've got nearly or to that point of resistance, and that's your exit point. So point 3, again, this is where the psychological side, and again, this isn't a psychological webinar. There's a whole topic on that for different techniques, but this is just a small snippet. So again, it's all about self-talk. There's only you. again, we're not like we're on the trading floor. We don't have analysts, we don't have our economists, we don't have, the whole teams of risk and all the other traders around us to gauge the opinions. We're just taking the information that we can see from the news wires, from the internet, from reading the papers, from the TV. Again, there's a lot to take on board. Yeah, we're our own trader, our own risk manager, our own economist, making our opinions, and we're physically trading. It's a tough job. So you've got to ask yourself these things that will give you the confidence. Okay, am I alert? Am I confident? Yeah, have I eaten? Have I traded like this before? All these little things, they might sound silly, but again, if they help you, then why wouldn't you ask these things? If you're sat there and you're thinking, I've no idea what this market's doing, and you're just about to press the button, if you lose, then what are you going to get from that trade? If you immediately go offside, the market goes against you, well, what have you really gained? You've not just lost capital, you've lost confidence. You've lost, you know, you've lost that little bit of spark. It's like, well, I wasn't feeling confident about that, and then the market proved to me that it wasn't the right trade to do, and I lost money. It's like, well, why would you do that? If you're not feeling confident, and you're not getting that feeling that the market's doing what you expect, then why are you trading? These little things, you add them up over a month, can make a huge amount of difference in the amount of money that you make in the long term. And again, I've done it as a risk manager with traders, and said if you're not feeling well, or you're not trading well, or you're just not feeling the markets, don't trade. And just, then kind of, you find yourself trading a little bit smaller size, holding on to trades for a little bit longer, trying to justify things, trying to find things in the news wires that could push the market against you. And sometimes, they're not there. Sometimes you're just wrong. But if you can control that and not trade or get out the trade very early, over a month and a year, you'd be amazed how much money, physical money, that'll save you. So probabilities and risk reward. So having identified the probability of success of a winning trade, you need to make sure you consider the risk reward levels. So again, this is very important. Did you put sufficient amount of capital to warrant the trade? As I mentioned before, if you're trading very, very small and then winning, and then trading big and making losers, then why? What's warranted these trades? Yeah, have you used your capital in the right way? Have you utilized the money that you've got on account? There's no point seeing a great level, tying it in with another indicator, a piece of news, and putting a small trade on. That's when you need to be putting a bigger trade on, saying that, okay, I've got the confidence. I've seen indicator 1, 2, and 3. This is tying in with this fundamental, this technical level. Okay, I'm going to put a big amount of size on the normal and reap the rewards of it. So again, trading is not just about managing risk. It's taking opportunities and trading on the right side of it when you're right. Okay, because that's, again, you might only get one feeling like that a month or a week. But if you can make good money out of that, then that's really going to bolster your capital. And again, it's going to make up for all the inevitable losing trades you're going to have. So again, could you have run the trade longer? Did you cut out too early? Again, what were your exit points? Did this tie into your plan? Did you just see some profit and take it? Or didn't you hold it long enough? Why did you get out? Had the market sentiment changed? No? Then why did you get out? Did you reach the key level? No? Then why were you out? Why were you not still in the trade? How many times have we get on side, see the market retrace towards us, and we think, oh, we must be wrong now, the market's gone, we get out, then immediately the market goes back to where originally it's high, and then continues to go further. Everyone wants to take profit at some point. You have to allow that into your risk reward ratio. Okay, that people will take money out of any direction. So if you see one 5-minute candle, yeah, you can always guarantee that it will probably retrace 33% of that move at some point for profit taking if the candle's big enough. So you let that happen and then let the market continue and carry on doing what you expected and knew it was going to do anyway. So that's the real art of tying in your risk reward and holding on to trades. Okay, so this isn't the best example, and again, it goes back to a betting example, which it really goes against everything I'm trying to say, but it just highlights the point of the difference between gambling, trading, and how people perceive value. The big thing for me is that if you're a trader, okay, and I ask you if you're up or down your account over the last year, you can't say to me, I'm about even. Okay, you cannot say that to me. You have to tell me to the pound what you're up or the pound to what you're down. That's what makes you a trader. Yeah, if you talk to any gambler, we can all do it down the pub or whatever it is, they will generally say that, yeah, I'm about flat. Rubbish. That means they're down. That, if they were up, they would know how much they're up. So if I say to you, I've got put £10 on this dead cert horse. It's 10 to 1. It's guaranteed to win. I think everyone would understand that's a worthwhile bet. What about 3 to 1? Okay, a little bit less exciting. What about 1 to 3? Okay, well, it's not very exciting at all. So why would you bet £3 to get £1 back? You wouldn't. It's the same with trading. So if you're trying to make £1,000, why would you put your stop loss at £3,000? Why would you risk that amount of money to make £1,000? It doesn't make sense. The risk reward has to be on your side. So it has to be positive. So you're risking £100, you want to be making at least double that to 200 or maybe 300. Yeah, that's the way you work it. So it's not about punting. It's not about just racking up the losses, racking up the winners, and hoping that you're on side. It's about controlling how much you stake, controlling where you are in your account, and making sure when you do see the good trades, that's when you've got the size on. And when you see the bad trades, or you see the trade you're not so sure on, you can control in the risk. You're not putting anything on that's going to affect you if it does go wrong. So everyone always asks me, it's a really common question, what's the correct risk reward? So again, as being a professional risk manager for Revco, difficult without being able to see your trading plan, trading style, knowing how much capital you have. It's very, very difficult. But the basic rule of thumb, and again, you can Google this, you can look at some other so-called experts, is around about 1 to 2. So if you're risking £1,000, £100, you want to be doubling it. So you can translate that into physical monetary terms or into tick terms. If you're trying to make 60 ticks or pips out of a market, then your stop loss, where you get out, should be 20 to 30 from your entry point. Okay, that's a sensible, responsible risk reward to have. But again, you're the trader. It all depends on if you're holding the trade for 5 minutes, 15 minutes, an hour, a day. It's entirely based around how the market's going to move and how it's going to interact with you before you get to your target outcome. So in conclusion, there are no certainties in life, obviously apart from death and taxes. Trading's no different. There's no guaranteed system. There's no guaranteed formula. There's no guaranteed system you can buy for $100 a month that's going to make you money. Yep, and I guarantee that. That's why we don't charge you for any of the information you get. You can watch me trade my money live, yeah, and I make money. You can listen to any of my webinars free. You can take the course for free. We offer this to help you, and you take what you want from the course. The more you invest in your own education and your own training and confidence, the better you're going to be. So that's why we don't need to say that we've got a guaranteed foolproof formula. We don't. It doesn't exist. So what you have to make sure is you're confident in what you're doing and you're applying your trading style to the right market conditions. We're not gambling. We're using the tools, analytics, and our instinct to predict market moves based on intelligent, fundamental, and technical analysis. What separates us from gamblers is the ability to manage risk. Yeah, we use this to our advantage. So again, if we look for the most probable outcome, we're doing the same as other people. The markets are self-fulfilling. So you don't want to be counter trend. You want to be going with the majority of traders and letting them push the market in the way that the markets want to go. Don't fight it, go with it. Okay, guys, is any questions? Anything we'd like to ask on trading probabilities? Any thoughts we've got on the markets? Does anyone got anything they'd like to add? Again, there's no right or wrong questions in this, guys. You know, anything that you ask could help other people. So so again, this is just one tiny element of trading. You know, we have lots of webinars. We have the course. Okay, John, find it hard to get your entry right. Of course. Now, there's two ways of looking at your entry point. So again, as I say in volatile markets, if you're trying to keep a relatively tight risk reward, you find yourself you get stopped out too easily. Is that the case, John? Okay, well, I'll just carry on talking anyway, but you can answer. Okay, well, you get stopped out because your risk reward is too tight. Markets can move against you very, very quickly. So what you need to do is always be looking at the extremes of the markets. So one tip or one good way for trading volatile markets is to trade half the size. So if you trade half the size you normally would, when the market moves against you, you can average in, yeah, to make an average price, and then put your stop even further away so it doesn't get hit. Yeah, that's one technique for doing it. But then also what you can do is make sure you're only involved in the extremes. So put your Bollinger Bands on. The Bollinger Bands will show you the extremes of the markets. So unless you're near or touching the Bollinger Band, yeah, you shouldn't be trading. So that's another technical term. Markets will always get pushed out and you will always get overextensions. But if you're always trading on the extremes, the probable outcome is you'll be right more times than you're wrong. Okay, so it's all about building it up. And this is the art of trading. So yeah, of course you can buy stock. Oh, hopefully that answers your question, John. If it doesn't, you know, just tell me. We can go into it a little bit further. Can you buy stock that's going down? Yeah, of course, but you have to understand why it's going down. Again, there's quite a well-known term that we used on the floor. is that catching pianos. If a stock is selling off, it's selling off for a reason. If you pick bottoms, you get smelly fingers. All these things happen in the markets. People talk about these things every day. You need to be clear where the market could go down to and where people are going to start finding value and push the market back up. There's no point saying this is a downside level. It should hold. Why should it hold? Yeah. What's changed the overall fundamental direction of the market? Okay, what time frame is best to confirm a trend? Okay, well, Dave, I'd say hourlies are generally the best time frame to confirm a trend. But I would say 15-minute candles, you can see each close if it's above or below the moving average, where it is in the range. That will build the picture up for the hourlies. So I'd say hourlies for confirmation. Then look how your 15 minutes close to kind of build up that smaller time frame. Okay, then you're okay at entry. Well, that's half the battle, Chris. But your exit point, you get out too soon. Okay, well then again, like I said to you before, what's telling you to get out of that trade? Is it just because you're on profit, or is something coming to the market to tell you that the direction of the market's changing? Have you heard some new fundamental news? Again, look for your closes. Look for your moving average, yeah? Stick in a 50-day and a 200-day moving average, okay? So if you trade off the 15 minutes, if you've got the direction right, yeah, and we close above or below the market, the moving average, depending on if you're going long or short, until it closes above or below it to counteract the trend you're going with, then stay in the chart. Look for your levels of support and resistance to be hit. Look for points to tell you that the market's telling you wrong. Look for the other markets that trade in conjunction. So if you're trading the S&P, what's happening in Europe? What's happening to the bond markets? If they're going with or against you, then until the market tells you that you're wrong, you stay in the trade until you've got something telling you that your opinion's wrong. Sometimes, again, the easiest way to stay in a trade is to not look at the charts. Put your stop in place, but wait for the closes. So unless the close of the next bar, be it 5, 10, or 15 minutes, is anywhere close or any kind of particular candlestick pattern that tells you the market's reversing, then stay in. Give yourself, or say, okay, I'm going to stay in this trade for the next 4 15-minute candles. Unless it closes below or above the moving average, or it prints a pattern that indicates the market's changing direction, I'm staying in until I hit my exit point. It's having that confidence to almost not look at the charts and let the charts evolve and do what they need to do. Okay, guys, okay, we've got some other questions coming through. Am I suggesting never hold a position over the weekend? No, not at all. I mean, again, you're the trader. Fridays are very difficult to trade, as we probably all know. So I'm not a great big fan of taking positions over the weekend in case something happens. But no, if you want to hold trade over the weekend, that's entirely up to you, of course. I would not tell you how to trade at all. I'm just saying the benefit of having 2 days off without a position on is you're a lot clearer and you're in a lot better position to predict what the market could do next week. That was the only point I was making. Okay, the best time frame for charts depends on the style and how long you want to hold charts. I generally trade off 15 minutes with an hourly overlay for the levels because that gives me 4 opportunities within the hour to understand where the market could go. So with a 30-minute, you only get 2. So with 50 minutes, obviously, you get 4 options to see closes and see the market move and build up in a reasonable amount of time. If you do this off minutes or 5 minutes, there's too much noise. So I would say personally, I trade at 15 minutes. Reasonable amount to start trading with, in my opinion. I'd say realistically between 200 and 500 pounds. It really is going to give you a chance to get involved in the markets. It's different for different people. There's no finite amount of money that's right, to be honest. Okay, how do you catch a big candle? Well, again, it's all about what's happened before to what's likely to happen. If you've seen a very tight range, a lot of small candles forming, you know at some point the markets will break out and there'll be overbuying and overselling. So you need to be in or preempting what's going to happen before the candle comes out. Order hover over by 1.7%. I'm not quite sure what that means, John, to be honest. How many indicators may I use? 5 or more. Again, it's entirely up to you. For me, the less indicators, the better. I generally have 1 or 2 moving averages, maybe Bollinger Bands, and then an oscillator like RSI or MACD. I don't need much more than that. You can tell enough from the candlestick patterns. You can make your charts far too messy, get conflicting signals if you have too many things on your charts. I'd say 2 or 3 tools in general with your trend lines. That's what I'd use. Okay, using price alert. Yeah, okay, John. Well, you can use any of the kind of price alerts or that kind of thing. The way I look at charts is that I don't need alerts. If I'm not looking at the charts constantly, then again, I don't have the confidence to trade. If the market's getting to a point and it's alerting me, I want to know how it's got there, why it's got there, what are the reasons, not just because it's got there. Yeah, I need to know the underlying reasons why it's got there. I want to see the charts form. I want to see the strength of the candles. I want to see all the other things that have made the market get there. If it's just gone up in one straight hourly green bar, then what's the likelihood it's going to continue? If it's ground up within 5, hourly bars, then again you might understand why. Again it's knowing why the market is where it is, not just because it's there. But again, it's a lot of the times when the market gets to a point, if you know where it's going to go to, then why aren't you buying towards or selling towards that level? Yeah, just because markets get there, that's only half the pitch. You want to know why they've got there. That's the other part of trading. We all know where the markets are going to go, but buying towards the upside and selling towards the downside, that's another way of making money. Not just finding the perfect levels that everyone's looking for to bounce and hold. That's not really trading to me. That's just one tiny part of it. Yeah, well, orders are pretty much the same as alerts, to be honest. There's nothing wrong with orders, and if you use orders in a controlled and the right way, then of course that's a very valid way of trading, and people make a lot of money every day by working orders at key levels. So yeah, of course, yeah, good question. Okay, you only trade the FTSE in the morning. Do you need to be aware of any other markets? Yeah, you have to be aware of all the European markets. But again, remember the DAX, the Euro stocks, the CAC, that's the Eurozone. So they might not be trading in unison with the FTSE. Again, the UK is slightly outside the Eurozone. We don't have the Euro. So maybe we're seen as a little bit safer. We've seen the stocks get, bought up and the FTSE not move. We've seen the Euro stocks get hit down and the FTSE go up. So remember, not everything correlates in the same way all the time. We have to find what correlates at that time, what's moving the markets, and then trade when we understand it. When we don't understand why the S&P is going up and the stock's going down in Europe, then we don't trade it. Okay? Because again, people will hedge, people have different opinions. Not all stock markets are always interlinked. There are some clear correlations, but they don't always work. So there's no point trading markets. Just because the S&P is rallying doesn't mean we have to buy, the Euro stocks. It's not quite as simple as that. If it was, then everyone would always just follow one indicator and make money. It's all about finding out why these individual markets are moving and going with that reason. I don't always trade in correlations. Again, I trade in correlations when they work. Again, it's back to market conditions. When the correlations aren't there or I can't see them, I don't trade them. So again, that's just years of being in the markets. To be honest, I'm happy to trade off candlesticks and trade off the market sentiment and my knowledge. But again, I'm trying to teach you, I'm trying to give you the benefit of all the years I've traded and all the hundreds of people I've seen try everything that you guys will have traded and tell you what does work and what doesn't. There's no magic answer. There's no magic correlation. There's no magic formula. It's all about just applying your discipline to the markets and trading with the right market conditions. Okay, you trade intraday with the trend and use the super trend line for your exits. And the market moves against me. It's a good idea. Well, again, yeah. I mean, again, trade with the trend and then use Bollinger Bands, use your levels for your exit points. Use the extremes of the markets to see where it could be pushed to. So that, yeah, that's completely. That's yeah. If the market moves against you, then you're either wrong or the market's got forming a different opinion. Well, guys, I mean that's some great questions. I can tell you guys have certainly been thinking about these things. Okay, Jeffrey. Yeah, well, that's great. I mean, it's all about being confident and using that as a tool. Confidence is a huge part of trading. If you can master that, you're going to be a lot better off and a lot more of the traders out there. It's a good thing to have. Easiest thing in the world. It's just like anything in life. When we think something is a bad idea and we don't do it, it's for a good reason. And it's just the same with trading. If you're not feeling confident when you press that button, the likelihood is because it's not going to be a good trade. But great, yeah. Cheers, guys. I appreciate that. All right, guys. Well, we've got a lot of more interesting new material coming up. So again, the advanced candlesticks is being rolled out. So hopefully, you should all tune in for that. That'll be a lot of help to you. There's trading with the Elliott wave. which again is very interesting. And then there's trading with Bollinger Bands, which is very important as well. So lots of new material. The Trade for a Living Building Blocks of Trading course is starting again on the 8th of May. So again, anyone that hasn't attended that, I would say that certainly the first 3 modules are very, very important. And again, you get a lot of handouts, a lot of work that I've taken years and years to write. And again, it's free. So again, if you want to invest in your time and trading career, then it's a very good way to do it. Yeah, I mean, I can write a presentation, John, on entry points and chart analysis. Again, there's nothing I can give you that's crystal, that's cast iron. Again, we have to take different bits because everyone sees the market in different ways, everyone trades in different ways, and everyone has their own style. And that's what makes the market so deliciously interesting. Everyone's got their own opinion on it. You can't always do the same thing and make money all the time, but it's being controlled, it's being disciplined, and not letting the markets get you down. Okay. Well, I appreciate that, Chris. I'm glad. I mean, again, we do probably 5 webinars a month. There's 2 live trading sessions on the course. There's plenty of opportunities to turn in and speak to other traders, speak to myself, get some ideas. Again, I'll put my email address down. So again, any questions you might have or any thoughts, you can always send them through to me. I can't always, reply instantly, but I'm always here for you guys to support you, and that's my job. And again, I trade my own money. I trade it live. I trade it real. We generally make cash, so I can't do much more than that, guys. Let me just get some feedback from you guys. Again, we've got a fairly good attendance tonight, so some new faces, which is very encouraging. Just let me know how you found it tonight. Again, any questions, send them through to the email address, and I'll get back to you. Check the schedule always for the next live trading session. There'll be non-farm payrolls and maybe another sentiment figure. But again, get involved in markets, guys. Be controlled, be consistent, and any problems you do have, then give me a shout. I can even give you a trading plan, even if you don't attend the course. Just send me an email and I can supply that. That's not a problem, guys.